You wake up and your phone is already screaming at you. Markets are down. Again. Your savings are shrinking on a screen you don't control. Your job feels suddenly fragile. Prices haven't gone down, but your confidence has. And somewhere in the back of your mind, a quiet realization hits harder than the headlines. The next market crash isn't a question of if. It's a question of how ready you are when it happens. Because crashes don't announce themselves politely. They don't wait for you to finish planning. They don't care about your goals, your timelines, or your excuses. They arrive when people are most confident, and they punish those who thought the system would protect them. If you think this is fear-mongering, let me ask you something uncomfortable. How many people do you know who are one paycheck away from panic? How many are buried under EMIs, subscriptions, lifestyle upgrades, and silent debt? How many believed the market always goes up right before it didn't? Crashes don't destroy everyone equally. They expose who is already fragile. And if you're not actively preparing, you're volunteering to be fragile. Let's get brutally honest about what's coming, and more importantly, how to survive it without losing years of your life. Every major market crash follows the same pattern. Confidence turns into denial. Denial turns into fear. Fear turns into bad decisions. People sell at the bottom. They freeze when they should move. They double down on hope instead of strategy. They wait for things to go back to normal. Normal never comes back the same. Inflation doesn't reverse cleanly. Jobs don't return to the same security. Purchasing power doesn't magically heal. And the most dangerous part, most people don't fail because the crash was unpredictable. They fail because they were financially exposed. Exposure is what kills you. Exposure means high fixed expenses. Exposure means income coming from one fragile source. Exposure means debt that assumes tomorrow will be better than today. A crash doesn't break strong systems. It breaks assumptions. The assumption that your salary will always come, that your savings will hold value, that your investments will recover before you need them, that someone, your employer, the government, the market, will step in. They won't. So survival starts with a shift most people refuse to make. You stop asking, how do I grow fast? And start asking, how do I not die financially? Because survival buys you time, and time is what creates leverage. The first thing that collapses in a crash is cash flow, not net worth, not paper wealth, cash flow. The moment income becomes uncertain, everything else turns hostile. Bills feel heavier. Decisions feel rushed. Fear becomes expensive. That's why the smartest people don't obsess over returns before a crash. They obsess over stability. You need income that doesn't panic when markets panic. This doesn't mean quitting your job tomorrow or gambling on some overnight business fantasy. It means building redundancy while the lights are still on. If all your income comes from one employer, one client, or one platform, you are not employed. You are exposed. Survival income is boring. It's unglamorous. It's resilient. It's skills you can sell even when companies are cutting costs. It's services that solve painful problems, not luxury ones. It's the ability to adapt quickly when demand shifts. In a crash, people don't stop spending. They stop spending on nonsense. They still pay for things that save time, reduce stress, increase efficiency, or fix real problems. The question is whether you can provide any of those. Because when layoffs hit, the market doesn't reward loyalty. It rewards usefulness. The second thing that kills people in crashes is fixed lifestyle. Your lifestyle is not your identity. It's your biggest liability. Rent, car payments, EMIs, subscriptions you forgot you had, obligations you locked in during optimistic times. During a boom, fixed costs feel manageable. During a crash, they feel like handcuffs. Every fixed expense is a future promise you made to a version of yourself that assumed stability. Crashes punish those promises. Survival means lowering the speed at which money leaves your life, not out of fear, but out of control. You don't cut because you're panicking. You cut so you can breathe. Liquidity isn't about having money. It's about having options. When expenses are low, you don't need to make desperate decisions. You don't sell assets at the worst time. You don't accept bad work from bad people just to survive. People say, live a little. Crashes reply, live with the consequences. The third killer is misunderstanding risk. Most people think risk is volatility. It's not. Risk is needing money at the wrong time. If you're forced to sell when prices are down, you weren't investing, you were speculating with a deadline. Survival investing is boring again. It assumes markets can stay irrational longer than you can stay patient. It assumes recovery takes time, and time costs money. It assumes you might be wrong, so you don't go all in on hope. You don't chase returns to compensate for insecurity. You don't confuse luck with skill. You build buffers. Cash buffers aren't for returns. They're for decision power. When others are forced sellers, you are calm. When others panic, you wait. When opportunities appear, you're not trapped. This is how crashes quietly transfer wealth, from those who must act to those who can wait. But there's an internal threat more dangerous than inflation or layoffs: your psychology. Fear makes people stupid. Ego makes them stubborn. Hope makes them delay. In every crash, people tell themselves stories. It'll bounce back next month. I don't want to lock in losses. I'll just wait it out. Meanwhile, reality keeps charging interest. Survival requires emotional discipline that feels boring when everything is fine, but priceless when it isn't. You stop checking prices obsessively. You stop reacting to noise. You focus on controllables: income, expenses, liquidity, skills. Everything else is secondary. And here's the part nobody likes hearing. Crashes don't just destroy, they reveal. They reveal which skills are actually valuable, which businesses were built on cheap money, which lifestyles were illusions, which people prepared quietly while others showed off loudly. If you survive the crash with stability intact, something strange happens. You see opportunities others can't touch. Assets go on sale. Talent becomes available. Competition thins out. This is how fortunes are built, not by predicting crashes, but by being positioned when they arrive. Survival isn't passive. It's strategic patience. You don't need to be fearless. You need to be prepared, because fear with preparation looks like caution. Fear without preparation looks like panic, and panic is expensive. So here's the real truth. The next market crash won't ruin you overnight. It will test you slowly, month by month, decision by decision, expense by expense. It will ask you questions you can't Google. Can you adapt when income slows? Can you sit on cash while others chase rebounds? Can you say no to comfort to protect control? Can you act rationally while everyone else reacts emotionally? Your answers decide whether the crash takes years from you or gives you leverage. Most people won't prepare. They'll assume stability is permanent. They'll delay hard decisions until they're forced. You don't have to be one of them. You prepare when it feels unnecessary. You simplify when others expand. You build resilience when others chase speed. Because when the crash finally arrives, and it will, you won't be asking, "Why is this happening?" You'll already know. And instead of panicking, you'll be moving, quietly, deliberately, ahead of the crowd. That's how you survive the next market crash. Not by predicting it, not by outrunning it, but by making sure it doesn't get to decide your future for you. So, if you like my video, subscribe to my channel and hit the bell icon for my upcoming videos. Thank you.